payable for 6 months, and it is as follows. So here we go. Our accounting period ends at December 31st, and the payment is on 1st of January, right? 1st of January and 1st of July. July, we have, this is in our accounting period, so it is cash. But the next term that we have to pay in January 1st, this is not in our accounting period. This is the next year of accounting period that he has to pay on 1st of January 2015, right? So that's why we create interest payable for 1 day, and next day on 1st of July we'll pay it. So that would be interest expense occurred. Yes, we use that 9% for 6 months, another 6 months from July to December, and that amount is again 2,250. Answer would be interest expense to interest payable. That's it, right? So that would be the entry. If the payment, here is 31st of December, then we will repeat this entry on 31st of December as well, since they said that they have to pay one interest rate on January 1st and second interest rate is on July 1st. Since our accounting period ends on December 31st, so we create for the payment of December 1st at payable. We don't pay cash, we create liability, and after when we pay that, we decrease our liability. That's it. Right, guys? Now here comes the, okay, now what happened? On July, you make the payment, interest payable to cash. That's it. Right, guys? Now here comes the challenge. Challenge on, okay. So now for the same, when we issue the bond at par, what happened? The company has issued 50,000 9% payable bond mature in 5 years. Now at maturity, January 1st, 2019, we have to pay back our loan, and our loan is 50,000. So what should be the entry? Bonds payable to cash. Simple, right? So you have to pay attention to the dates and to the calculation of interest rate. That's it. Interest expenses. That's it. Now we finish the treatment of bonds that are issued at par. Okay, before going into the treatment of bonds issued at discount, let's take 10 minutes break and then we start from here. Okay guys, welcome back after the break. Okay, let's talk about the issuing bonds payable at discount. So the idea here is that when company issued the bond, the only concern is that, you know, it records transactions the issuance transaction, the interest during the life of the bond, and the third one is paying back Sorry, guys, where it goes. And paying back the principal. That's it. So what happened to the price of the bond during the life of the bond? It doesn't concern with the company. Why? Because once company issued the share, received the money, company is busy spending that money according to the bonds charter. That, for example, if the company issued the bonds, with the intention to purchase some kind of a plant or business expansion, or with some kind of mergers, or issuing a new product line. So it's busy in establishing those commitments. So it's, don't worry about what will happen to the price of the bond during the year. And at the end, he just only concerned about the interest payment during the life of the bond, and he's concerned about the payment of the bond at the end of the maturity date. That's it. So all those questions are meaningless here with the company's perspective, that what will happen to the price of the bond right now during the life of the bond, and how we are going to account for, because company is going to account for only issuance of the bond when he received the money from the bond, when he pay the interest, and when he pay back the principals, and that's it, right? Okay, now let's talk about the illustration, how we deal with the bonds payable at discount. Here we go. So Southwest Airlines issued $100,000 bond of 9%. So what is this 9%? This is coupon. A 5-year, it means the maturity time is 5 years. When the market interest rate is 10%. So you see that the market is it is 10%, and your coupon is 9%. So definitely you will issue the bond at discount. So the market price of the bond drops, and Southwest received 96,149 at issuance. So how you are going to record this transaction, right? So where this value come from? It came from the formula, and we are not discussing here because that is a finance and investment topic over there. So you will be given all these. So what is the difference between, so company issued the bonds total worth of 100,000, right? Instead company receives instead company receives where are we? Instead company received 96,149. So what is the difference? Difference is called discount. And remember what we discussed at our slide here. Discount is a balance. Which balance? Debit balance, right? Let's now talk about that. So company received cash 96,149. Cash increase means asset increase, so it's debit. And then discount, which is 3851, and bonds payable. Why? Because at the end of the 5-year, company would have to pay $100,000. So commitment or liability is there. Liability is of 100,000. Against 100,000, company received a cash of 96,149. So the difference is, of course, company issued discount, right? And the discount is 3851. Right, guys? This is how we account for the issuance of bond at discount, right? Now, real deal started. How we have,
Wait, could you go back for a second?
Yeah, sure.
I just don't really get why on a discount would so when the company gets money by selling a bond at a discount, they just get less. What happens to the discount? Where does it go?
That's what we were talking about in our coming slides. What will
Okay,
happen?
okay.
Okay,
Sorry.
good. No worries. It's good. I like that you are attentive. Okay, so here we go. So if we see on equation side, the equation side is balanced. How? Because we receive the cash and we adjust in liabilities as the discount. But that's the accounting equation is not authentical, right? We have to show it on balance sheet, right? On balance sheet, how we are going to, represent the bonds payable under long-term liability, and we write it down. This is our commitment, and this is our discount, and this is the current value of bond. Now, what we have to do with the discount, right? Our liability is 100,000 after 5 years, but we receive 96149. So what did I tell you? That whatever is the value of the bond, it approaches to face value at the end, right? It means bond value, which is bond payable minus discount, this will increase to 100,000 at the end of 5 years. It means that discount would be amortized or would be divided into 5 years, and every year it is added in the value of the bond here, so that it increases and becomes to face value or principal value or maturity value at the end. How? Let's talk about this. So how we are going to deal that? We are to deal that with loan amortization. So let's talk about this. So we understand it through this example here. So guys, be very attentive here. Okay, company issued the bond on 1st January 2014. Maturity date is January 1st, 2019. 5 years. Its face value is 100,000. Okay. Its stated interest rate coupon is 9%, and you have to 9%, and what is okay, and 4.5% semi-annually. So 9% divided by 2, it is 4.5, or 4 by 5%, right? So don't worry about this. This is not 41 divided by 2%. This is 4.5%. So interest paid semi-annually, which means interest is paid on January 1st and July 1st. The market interest rate is 10%. And the issuance price is 96,149. Okay. Whatever is the market interest rate, company have to pay how much? 9% of 100,000. Okay, I think my internet connection just. So can you hear me now?
Yes.
Okay, so that was our given data here. So remember, whatever is the interest in the market, company would pay